But if it continues at the same pace, we will see, in all probability, gold keeping pace with the rise in government debt. So what would that mean? It would mean by 2027, we might be looking at a gold price of 5,900. That's a best guess at it. It's not a prediction as such. By 2030, we might be looking at 7,800. By 2040, we might be looking at 18,900. And by 2050, $50,000.
I think that not only is gold the money of the past, but it will be the money of the future. It hasn't been money in the present, although central banks still hold it as money, and they've been buying a lot more of it as their reserve for their currencies. There's no stability in the dollar, and if you're going to hold a non-interest-bearing instrument, why would you want to hold non-interest-bearing federal dollars when you can own gold?
In this discussion, precious metals expert Clive Thompson reviews the performance of gold against government debt, noting that both are displayed on a logarithmic scale. The speaker observes that gold has historically kept pace with the rise in government debt and the expansion of the money supply. Projecting this trend forward, he offers best guesses for the gold price: approximately $5,900 by 2027, $7,800 by 2030, $18,900 by 2040, and potentially $50,000 by 2050. However, Thompson expresses doubt that the price will reach the highest figures, as he anticipates a major currency event, such as a replacement, failure, or spiral out of control, before 2050. He emphasizes that a rising U.S. government debt burden and the sharply increasing interest paid on it historically support gold prices through outcomes like higher inflation, restructuring, or capital control. Let's watch clips from Clive Thompson's explosive interview to gain more insight. So if you're new here, make sure to like the video, subscribe to the channel, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Let's just have a look at how gold has been performing versus government debt. On this chart, you can see the green area is the government debt, and the red line is the gold price. Both of these are on a logarithmic scale. So on the left-hand side, we've got the log scale for government debt, and on the right-hand side, we've got the gold price in dollars, also a log scale. And I've drawn a blue line, a straight line here, which roughly matches the past growth in government debt. If it were to continue at the same pace, and I stress that a lot of people think it will accelerate at a faster pace, me included, but if it continues at the same pace, we will see, in all probability, gold keeping pace with the rise in government debt. So what would that mean? It would mean by 2027, we might be looking at a gold price of 5,900. That's a best guess at it. It's not a prediction as such. By 2030, we might be looking at 7,800. By 2040, we might be looking at 18,900. And by 2050, $50,000. Now, I don't seriously think we're going to get to these high numbers, because I think the currency something's going to happen to the currency before then, whether it's replaced by a new currency or there's a complete failure or a spiral out of control, I don't know. But my feeling is something's going to go wrong before we get to 2050 and see $50,000 gold price. But anything is possible. So keep be prepared for the unexpected too. So the gold price is keeping pace with the expansion of money supply, it's keeping pace with the expansion of government debt, and those trends, which are almost looking like they're straight line or accelerating, they're not likely to go down, and probably the gold price will continue to keep pace with the rise in debt and money supply. That's what they've tended to do in the past, what gold's tended to do in the past, and probably what it's going to do in the future. One of the big problems with US government debt is the interest on that debt. Because the level of debt has risen as a percentage of GDP, so has the interest burden as a percentage of GDP, and we're in a higher interest rate environment than we've been in for the last 15 or 20 years. So currently, the interest being charged or having to be paid on national debt is increased at quite a fast rate. So in 2021, the interest on the US national debt amounted to $352 billion. That's the figure from the Congressional Budget Office. $352 billion in 21. 3 years later, in 2024, it was more than double at $881 billion. So it's gone from 352 to 881 billion in 3 years. The interest burden is going to keep rising according to the Congressional Budget Office, their own numbers. It could be worse than they expect. The Congressional Budget Office is forecasting that the US government debt owned by the public will reach 120% of GDP within a decade, and it might go faster than that. When debt burdens rise, history suggests several possible outcomes: higher inflation, restructuring, or some form of capital control. All of these scenarios, if they occur, have historically been supportive of gold. We know portfolios have very little gold in them. It's somewhere in the range of 0 to 1 or 0 to 2%. And most portfolios have no gold at all. But this now appears to be shifting. Some banks and some institutions are starting to come out and say that portfolios should hold a little gold. And hats off to Morgan Stanley. Their chief investment officer favors a 60-20-20 portfolio strategy with gold as an inflation hedge. So basically, he's looking at moving from the traditional 60-40 approach in equities and bonds to a 60-20-20 approach where gold is one of those 20s and replaces half of the bonds. Another bank which has started to recommend gold, and there are a few others, is Standard Chartered. Ray Dalio, you may have seen, has come out and said that investors should have 15% of their portfolio in gold. Now, we've got central banks accumulating gold at a record pace. They're buying more than 1,000 tons a year for the last 3 years. And the high prices, the record prices, are just not deterring them. And let's face it, after all, they can print money as much as they like, so why would they care if the price is at an all-time record? They don't care, they just want more. So why do they want more? Why are they buying? Well, they want to diversify away from the dollar, they're hedging inflation, they're preparing for geopolitical risk, and they're increasing their resilience against unforeseen events in the world markets. And who's leading the purchases? Well, we know that mostly the big buyers are the emerging markets. They're countries like China, Turkey, India, Poland, and Kazakhstan, for example. Surveys are showing that around 81% of the emerging market reserve managers expect to increase their official gold reserves over the next 5 years. You can find the results of that survey on the World Gold Council website.
Economist and gold advocate Peter Schiff argues against the claim that Bitcoin is the money of the future, asserting that gold is not only the money of the past, but will be the money of the future. Schiff contends that Bitcoin's value is purely subjective and lacks the intrinsic value of gold, which has served as money for thousands of years and is still held as a reserve asset by central banks. He views the vast majority of Bitcoin adoption as a speculative get-rich-quick scheme to amass more dollars, pointing out that Bitcoin has lost significant value relative to gold since its peak. Schiff believes that the real long-term digital innovation will be tokenized gold on the blockchain, providing actual stability unlike fiat-backed stablecoins. Now, let's watch some clips from his interview.
A lot of people claim that gold is the money of the past and Bitcoin is the money of the future.
Here we go.
Do you have any thoughts on that?
An interesting question. Yeah, well, you know, I think that not only is gold the money of the past, but it will be the money of the future. It hasn't been money in the present, although central banks still hold it as money, and they've been buying a lot more of it. as their reserve for their currencies. But I think that the people who are advocating for Bitcoin as some type of digital alternative to gold, and that it's going to take on the role in the future that gold played in the past, I think that's based on a flawed misunderstanding of what money is and why gold became money, and the conceit that just a artificial string of numbers can somehow replace the real value of gold and the reason that it's been money for thousands of years. I mean, Bitcoin has certainly replicated some of the monetary properties that gold has, but not the intrinsic value of the metal, without which it never would have became money. But I think it's ironic that I think to the extent that blockchain is relevant in the future when it comes to money, it will be because of tokenized gold on the blockchain. And I know we're going to talk a lot about stable coins. Well, the best stable coin you can have is one that's backed by gold, because there's actual stability in gold. There's no stability in the dollar. And if you're going to hold a non-interest-bearing instrument, why would you want to hold non-interest-bearing federal dollars when you can own gold, and then you can transact with gold and receive payments in gold for your goods and services, your labor, rather than a fiat currency that's losing value? You can receive real money that preserves its value, and you can negotiate it as easy as anything else. When you talk about adoption, I don't know why people keep saying Bitcoin adoption. What are they adopting it for? They're not adopting it as money. People aren't buying Bitcoin, the vast majority, for the reasons that we're discussing. They're not looking for an alternative to the dollar. They're looking for Bitcoin as a way to amass more dollars. They're buying Bitcoin because they think the price is going to go up and they'll be able to sell it and get more dollars than they started. So yes, it's succeeded for 15 or 16 years because we haven't run out of greater fools to buy Bitcoin at a higher price. And what's happened recently to kind of propel it higher is some of the early adopters, the big OGs who bought Bitcoin a long time ago, amassed so much money in this pyramid that they were able to, entice Wall Street to get into it with the prospects of making money, booking bets on Bitcoin with ETFs and getting underwriting fees on Bitcoin treasury companies. And then they had so much money that they bought off politicians. They bought off Trump and they put him in office, and now they're using the power of the government to try to extend this scheme and get more people into it, not adopting it as a medium of exchange or a unit of account or any kind of money, but as a get-rich-quick scheme, as they ride the Bitcoin rocket ship to the moon, and it goes to $1 million or $10 million of Bitcoin, and that's what's going on. Why has Bitcoin lost a third of its value priced in gold since its peak? In fact, Bitcoin is worth less in terms of gold now than it was 4 years ago, despite all this so-called adoption. If you take the Bitcoin president, all the Bitcoin ETFs, all the Bitcoin strategy companies, Bitcoin has lost a third of its value relative to a rock. The reason right now the demand for tokens is primary as a get-rich-quick scheme. It's speculative money trying to get rich, and therefore they're not interested in a gold token.
We're not talking about gold mining companies. We're talking about money.
Let me finish. When the demand for tokens becomes to use them in the real world as a substitute for money, as a medium of exchange, as a unit of account, that's when demand for gold tokens is going to grow. But right now, it's just a speculative frenzy, and so people don't want to buy gold because they don't think there's enough upside. They want to buy what's going to go to the moon, right? That's what they want, and that's where the demand is. There are a lot of gold-backed tokens, but it's interesting. You're talking about Tether. What has Tether been buying? They're buying gold. They're taking the money that they're getting and they're buying gold. They're buying gold royalty companies. They must know something. They're buying all this gold with the dollars they got.
Both Clive Thompson and Peter Schiff's perspectives converge on a single powerful conclusion. The future of money will be defined by fleeing fiat currency. Thompson models gold reaching potentially $50,000 by 2050 based on accelerating government debt. but doubts the price will be realized due to an inevitable currency crisis. Schiff agrees on gold's long-term dominance as real money and views Bitcoin primarily as a speculative rush for more dollars. The common ground is a structural loss of confidence in the dollar, forcing a shift to hard money alternatives, with institutional interest now balancing gold as the proven safe haven against Bitcoin as the high-volatility digital competitor. If you found their breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.